Now more than ever, it's important for retirees to take full advantage of every tax break available. That's why we're bringing in Certified Financial Planner Joe Bert. Joe, good to see you.
Good morning, Andrea. Good to be seen.
Well, so you're going to touch on several different tax breaks here that are often overlooked. Let's start with one the CARES Act allows.
Well, what the CARES Act allows now, it says that if you have taken money out of your 401k or IRA because of the required minimum distribution law, the good news is if you took it out after January 31st, they say you can put it back and not have to pay taxes on it. So that's a great thing for a lot of folks that perhaps don't need the money. You can avoid the taxes that you normally be due on the required minimum distributions. That's a terrific thing.
What about a larger standard deduction at age 65?
Well, this is nice for those that are over age 65. You know, they eliminated a lot of the personal exemptions with the tax law passage a couple of years ago. And if you're over the age of 65, you can get an extra $1,650 as an individual, or if you're married filing a joint return, you get an extra $2,600 on top of the $24,400. So that extra $2,600, if you're in the 25% tax bracket, save you about $600 in taxes, and that's not bad.
Let's talk about possibly deducting some Medicare premiums.
Now, this is great. If you are self-employed after the age of 65, first of all, if you're at the age of 65, most people are taking Medicare. And Medicare, they have premiums are Part B you have to pay for, and then Part D, which is your drugs, and then if you have a Medicare supplement. Those generally are not tax deductible. However, if you are self-employed, you can take a tax deduction for that stuff. So if you have some self-employment income after the age 65, there are some tax benefits for you there as well.
Let's talk about an IRA deduction for a non-working spouse.
Yeah, what you're now allowed to do is after the age of 70, before you couldn't put money into an IRA, after the age of 70, you can now put money into an IRA if you have earned income. And if one of you has earned income, you can put it in for your spouse. And the maximum that you can contribute over the age of 70 now is $7,000. So once again, if you have earned income over the age of 70 and you're looking for some tax deductions, you could put $7,000 in for yourself if you have income, and $7,000 for your non-working spouse. So you can get an extra $14,000 of tax deductions. So all that stuff adds up at the end of the year, and we're all looking for tax deductions.
And what about giving money to charity from your IRA?
Well, this is the idea of taking money directly out of your 401k. It's a direct contribution from your IRA or your IRA, not your 401k. Your IRA is going to go directly to the charity and doesn't pass through you, and that'll save you some money, at least on the bottom end of what's called your adjusted gross income in terms of where your tax or your Social Security might be taxed. So if you have money in an IRA and you're normally charitably inclined, you can give up to $100,000 out of your RMD after the age of 70.
That's where we depend on people like you, those certified financial planners, to help us muddle through all of this.
Well, that's what we do for a living, Andrea. That's why we're here.
Very good. Joe, always great to see you. Where can people find you?
Once again, just Google me, 2 words, Joe Bert, B-E-R-T.
All right, Joe. Thank you. Have a wonderful day.
You do the same. Thanks. Bye.